This is an exciting time to be an investor in Japan, and indeed global capital is increasingly turning its attention to the country. We spent almost 2 weeks in Japan, meeting dozens of companies, discussing the issues and getting a feel for who is the best positioned to capitalize on these trends and drive alpha for investors.
We're here outside Komatsu's office in Tokyo for the very first meeting of our Japan trip. Komatsu is a global leader in the sale of equipment for the construction and mining industry. And given the nature of the industry it works in, it has typically been a fairly cyclical company. But we believe they might be at the start of a period of strong secular growth, underpinned by demand for transition minerals, copper, nickel, lithium, minerals that basically underpin the transition to a lower carbon and eventually net zero economy. At the moment, Komatsu is the beneficiary of strong orders from mining majors who are increasing capacity to meet that demand. And we believe that they, along with other companies enabling the net zero transition, should see strong secular growth for many years to come. And we'll be on the lookout for companies like that during our Japan trip.
Japan offers up supportive interest rates, modest inflation, strong geopolitical relationships with the West, and an improving corporate governance backdrop. We think Japan presents an amazing opportunity set for global investors. There are a huge number of very, very high quality global winners in the Japanese market, especially in areas like automation, in the semiconductor space, and in technology more broadly. Semiconductor stocks like Hoya, Disco, and Advantest all sit at the core of increased digitalization in the world, and many will play an important role in driving the growth of artificial intelligence. And at the same time, Japan is going through this incredibly important period of governance reform. The Tokyo Stock Exchange is encouraging Japanese companies to pay higher dividends, to engage in buybacks, and to shut down low return on capital businesses. This is resonating now in corporate Japan. And as companies focus on returns and becoming more shareholder friendly, this can only be a good thing for investors in the market. The trip left us more convinced than ever. And if we think about some of the big structural megatrends that we are trying to play in our global funds, Japan is at the forefront of so many of these. Gaming's been one of Japan's world-leading sectors for a very, very long time. And we've just met with Nintendo here in Kyoto. And I think it was interesting that Game Boy in the 80s and arcade games before that in the 70s, and nobody typifies that more than Nintendo. I mean, Nintendo has one of the world's leading content collection. You know, its IP is absolutely world-leading, right up there with Disney. But it's been frustrating from an investor perspective for a while that they haven't been that creative in monetizing that incredibly rich IP. And I think it was interesting that perhaps we started to see the first green shoots of a less conservative, more adventurous monetization of that IP. Because, for example, they talked about more in-game monetizations on the mobile platform, more free-to-play. They talked about the success of their new Mario movie and how that's had a feedback loop to drive more downloads of Mario games. And they also talked about coming videos, perhaps even more movies, other creative non-gaming content that they're working on at the moment. And on top of that, they're slowly growing the share of revenue that they generate through the digital sales channel. It's about 50% now. It was 10% back in 2016. That, they said, could continue to creep up towards 75-80%, which is positive for the margin. So I think we're starting to see the first green shoots of a more aggressive monetization of that IP, which would make Nintendo a materially more attractive investment. You're actually seeing wage inflation for the first time in about 30 years. You're having the major unions in Japan demanding generationally high wage increases. And we sort of saw that when we met Pan Pacific Holdings earlier, talking about doing the first wage hikes for their store staff in many years and hiking their wages by about 6 to 7%. You have high jobs to applicant ratio, and you have a working age population that actually peaked in 1995. It's a shortage that is only going to become more severe in the coming years as countries like China, Japan, and Korea see birth rates well below replacement rate. Automation companies like Keyence or Fanuc are vital to tackling the fact that we have an increasing shortage of productive labour in the world. So really the routes out are either more automation, and we're a big investor in that theme in Japan and globally, or more inbound immigration. And I thought it was interesting that Pan Pacific Holdings actually told us that 40% of the store staff in their Shibuya store are non-Japanese nationals. Now that would not have been the case 10, 15 years ago. That is a definite change or increase in inbound immigration.
So Simon, we just met with Toyota Industries. What would you say were the main takeaways from that meeting?
Well, the main takeaway is that there's obviously a slowdown going on in many areas, and Toyota Industries are number one in logistics field, specifically for forklift trucks. The likes of Amazon having undergone massive capex. You saw big boom years in 2021 and 22 within the industry. You had volumes that were circa 15% higher over those 2 years. And that's not structural, that's going to come back. What we learned really is that Toyota Industries is going to see 1 or 2 years of negative order growth, but that doesn't necessarily mean that they'll be producing negative revenues, because lead times on their equipment are still very long indeed. And as those normalise, then Toyota Industries and its peers could very realistically produce a couple of years of flat revenues rather than actual declines. So they could turn out to be somewhat more defensive businesses than the market expects.
The lean years in Japan are over, and it is very much a market for the future.